Wholesale prices in the United States just posted their biggest monthly jump in more than 4 years. The Producer Price Index for April rose 1.4% on the month, nearly 3 times what Wall Street was expecting. And the annual rate now sits at 6%, the highest reading since December 2022. The Bureau of Labor Statistics released the figures Wednesday morning. The Dow Jones Consensus had penciled in a 0.5% monthly rise. The actual print came in at 1.4%, the largest monthly gain since March 2022, when the U.S. was still working through the first post-pandemic inflation shock. Strip out food and energy, and the picture does not get cleaner. Core PPI rose 1.0% on the month, more than double the 0.4% forecast. Strip out food, energy, and trade services, and prices still climbed 0.6%. There is no clean read of the data that makes this print look benign. Now to where the pressure is coming from. Energy did most of the visible damage at the headline level. The final demand energy index jumped 7.8% for the month. Inside that, gasoline alone surged 15.6%, and gasoline was responsible for roughly 40% of the total increase in producer prices that businesses paid in April. Upstream, the picture is worse. Unprocessed energy materials surged 9.2% in April and are now up 48.9% year over year. Crude petroleum prices climbed 11.3% on the month. The driver here is not a mystery. Oil is trading near $102 a barrel, up roughly 78% year to date, with the ongoing US-Iran conflict keeping crude bid through the spring. But the more concerning detail for the Federal Reserve was not on the energy side. It was in services. The final demand services index accelerated 1.2% in April, the biggest single-month jump since March 2022. The BLS attributed nearly 60% of the entire April rise in producer prices to that services advance. Inside services, trade margins rose 2.7%, accounting for roughly 2/3 of the services move. Wholesaling margins for machinery and equipment jumped 3.5%. Transportation and warehousing services climbed 5%. The breadth here is the tell, and the trade margin spike is the line analysts are reading as early evidence that tariff costs are now moving through the supply chain into wholesaler pricing. David Russell, global head of market strategy at TradeStation, told CNBC inflation is sticky and accelerating, that the core reading confirms a deeper structural trend, especially in services. Russell added that the Hormuz crisis is aggravating the problem, but this goes way beyond oil. Markets responded immediately. The Dow Jones Industrial Average dropped more than 240 points in morning trading Wednesday, falling about 0.5% to roughly 49,518. The 2-year Treasury yield, the maturity most sensitive to Fed expectations, climbed from 3.98% to 4.02%. The dollar rose. Gold slipped. Bitcoin fell below $80,000 intraday. Federal Reserve futures had priced in close to a 50% chance of an interest rate hike by December, heading into the release. CNBC reported that following the PPI print, market-implied odds of a rate hike this year climbed to about 39%. But the bigger signal is that pricing for any rate cut through the rest of 2026 has almost entirely evaporated. The Fed has held its benchmark rate in a range between 3.5 and 3.75% for 3 consecutive meetings. Here is the part that matters for consumers. Producer prices are wholesale prices, the prices businesses pay before goods and services reach the consumer. They do not translate one-for-one to the prices on the shelf. CNN Business noted in its coverage that the report does not guarantee consumers will see prices rise at the same rates that businesses are experiencing. But the pass-through dynamics vary sharply by category, and the timing varies even more. Energy passes through fastest. Wholesale gasoline price changes typically reach the pump within days to weeks. Packaged food and dry goods take longer, usually 1 to 3 months, depending on retailer inventory cycles and margin policies. Services inflation is the slowest to show up, but also the hardest to reverse. Once labor contracts, transportation rates, and wholesale service margins reset higher, they tend to stay there. That is what makes the services side of this PPI print structurally concerning. Now to the specific places this shows up. Gasoline first. Retail gas averaged roughly $4.30 a gallon nationally in late April, per AAA reporting, already up sharply on the year, with California averages above $5 and parts of the state over $6. The U.S. Energy Information Administration estimates crude oil accounts for roughly 45% of the retail gasoline price in 2026, with crude up 78% year to date and wholesale gasoline up another 15.6% in April. The pump will continue to track that pressure through the spring driving season. And consumers are already adjusting. Fuel tracking firm Upside reported that drivers are buying approximately 9% fewer gallons per fill-up versus the pre-conflict baseline, visiting stations more often, but topping off rather than filling. Groceries next. The Food at Home Consumer Price Index was up only 1.9% year over year through March, relatively contained at the retail level. But the gap to wholesale is widening fast. Bank of America Global Research recently flagged that spot wholesale inflation for U.S. food and beverages surged 7.9% year over year, the biggest jump in roughly 12 months. Beef and veal prices were already running 15% above year-ago levels, per USDA data. With diesel and fertilizer both responding to the Iran conflict, food distribution costs are pushing in one direction. Restaurants are a separate story. Food away from home inflation has been running near 3.8% year over year, almost double the food at home rate. Restaurants pass costs through more consistently than supermarkets do because labor, rent, and operational expenses are harder to absorb at restaurant margins. Shipping and services third. The 5% jump in transportation and warehousing services in April flows directly into retail freight contracts, last-mile delivery fees, and the shipping cost baked into everything from online orders to restaurant takeout. Service prices in general, auto repair, home contractors, anything machinery dependent, face direct exposure from the 3.5% spike in machinery and equipment wholesaling margins. These are the categories where the price increase usually shows up as a line item the consumer never quite negotiates. Inflation is not distributed evenly. Energy and food are the two most regressive categories in the consumer price basket. Lower-income households spend a substantially larger share of their income on both, which means a 6% producer price increase, concentrated in those areas, hits those households harder in real terms, even before any of it reaches the register. Economists describe this asymmetry as regressive, and it has been a consistent feature of every energy-driven inflation episode in recent decades. The macro print does not capture it. The grocery bill does. Real wage growth, that is, nominal pay gains adjusted for inflation, has been narrowing as headline inflation reaccelerates. April Consumer Price Index at 3.8% year over year is the fastest annual pace since May 2023. If wages do not move with it, household purchasing power compresses. That is the part of this story that does not show up in a Dow chart, in a Treasury yield, or in a Fed funds rate range. What to watch next? 3 data points sit at the top of the calendar. The May retail sales report from the Census Bureau will show whether consumers are still spending through the price pressure or starting to pull back. The May CPI release will confirm or push back on the wholesale to retail pass-through timeline. And the Personal Consumption Expenditures Price Index, the Federal Reserve's preferred inflation gauge, lands later in the month and will be the cleanest read on whether the central bank's hand is being forced. The takeaway is this. Inflation is no longer being driven only by the energy shock from the Iran conflict. The April PPI shows price pressure widening into services, and the trade margin data suggests tariff costs are now visibly moving into wholesale pricing. That is a different problem than a gas price spike. It is harder for the Fed to look through, and it sets the stage for higher consumer prices in the months ahead. The wholesale wave is moving. The question is no longer whether it reaches the shelf, only how fast it gets there, and which households absorb the hit first. This is Alpha Wire, Thanks for watching and see you in the next one.